Greetings investors. If we are talking about investing approaches, obviously we have to cover value investing because this is like one of the fundamental investing approaches. And when we talk about value investing, we cannot ignore Peter Lynch and his performance at Fidelity Investments, or specifically his Magdalene fund, because like since 1977 till 1990 he actually averaged 29.2% return. This is consistently double of the S&P 500, and this is the best performing mutual fund in the history in the world. Secondly, it was the largest mutual fund in the world, and nextly, but not least, it was a mutual fund. It was not private portfolio or hedge fund where he could do everything he wants. Mutual funds has rather strict regulation, and they are tied to their diversification and risk management tools. So he had to compromise in great depth by diversifying into assets and stocks he didn't like. Simply regulators asked him to do that. So if we consider all these factors, that's nothing short of staggering if one could make these kinds of returns. So he himself is proponent of value investing, and you could actually read his book One Up on Wall Street. Where is the reference to that book? Anyways, I cannot find it now, but you could just Google it, Peter Lynch, One Up on Wall Street, and this is like one of the greatest books on investing philosophy and investing approaches of all time. So I strongly recommend you to read them, and let's see further what he actually sees by his approach. Well, the approach is simple. Firstly, invest in what you know and what you understand, because otherwise you cannot understand how you value companies, how you stack companies, and why something rises or falls in certain levels. Like, this is obvious, this is investing 101, but it's better to understand it. And secondly, let's go further. Let's go to actual selection process. What he actually did, and he showed in his work One Up on Wall Street, he devised list how you could actually separate different stocks. There are slow growers, something like Coca-Cola, big stable companies, but it wouldn't make you a fortune. Same thing about stalwarts, companies that are still able to grow, but at the levels of general market. These are like Coca-Colas and these types of things. These are, in first, like slow growers are more like dividend companies, which could pay you dividends and give you stability. It has its place, but it won't make you rich. This is in the first and second cases. Then there are fast growers, which is kind of obvious, small companies or growth stocks, but they fluctuate rather a lot, so pros and cons everywhere, like cyclicals. This is something like real estate companies. These are many financial companies, like car producing companies and companies like that, those who goes to boom and bust cycles. In short, now next is turnaround. These are a bit more complicated to explain, but in general the idea is that company is pretty bad and you are kind of buying to the premises that it will restructure itself. So you are either buying distressed debt or convertible shares or some sort of special situation where you could simply see something which is very cheap. But for this is special approach and requires special times. And last but not least, this is asset opportunities. In other words, these are companies who have certain assets which are not seen and reflected to actual stock price. There could be inventories, there could be natural resources, patent rights, goodwill, or some sort of things that has huge value but no one has seen it. And also in modern world, like, this happens rarely, but if markets crash, there might be opportunities here. So this is needed because you have to understand where you invest. If you invest in slow grower, you are effectively making investment for fixed income. If this is turnaround or asset opportunity, you have to have special angle how to invest. And same about cyclicals, you have to understand industry of cyclicals and in which place this cyclical is now. But generally, if you are a regular investor, you probably have diversified your assets between stalwarts and fast growers. This is the bread and butter of regular people who wants to make good, reasonably predictable returns. You could have percentages in fast growers, percentages in stalwarts, and something for hedge in slow growers. So this is typical criteria. And then when you understand that, how much you want to make and what are the companies, then you could go to selection criteria, which is earnings growth, price to earnings ratio relative to historical average, other types of price to earnings ratio, ratio of debt to equity, net cash per share, dividend payout ratios, inventories, and things like that. I wouldn't go there into details, but to understand that you have to weed out best and worst companies by their financials. So for instance, you could say that you have to look for stalwarts. You look only for the stalwarts in your screeners, and then you could basically weed out good and bad stalwarts according to the ratios. Then you could have list of stalwarts which is reasonable, and then you have to go do some subjective thinking, like hot stocks in hot industries, companies with big plans that are not yet proven, profitable companies engaged in diversifying acquisitions, and companies which has, for instance, risky business model. These 4 companies have to be deleted. So this is separation process, and then you have a couple of stalwarts left, and you could invest in these stalwarts. This is like regular Peter Lynch approach. Now this goes into depth. I don't want to re-quote every book or something a bit more specific, but I would just get you an idea. You have to understand what you are aiming at, and then you have to look at stocks at specific industries, or not specific industries but for specific type, and then you have to make sense whether a company have good returns on equity, good debt situation, whether they have stable financials, so you are weeding out bad ones, and then you have to make some subjective criteria to see that you are not going for extremely undervalued stock because everyone knows it. So now then you have like reasonable approach that stock is the best, and if its value is significantly low below its price, you could buy a bunch of these stocks. This is, in simple words, Peter Lynch approach. Now of course I'm not saying something new here. There are people who have been trying this before me, and it's not that straightforward, but just give you a glimpse that this works. And actually you could go for some stock screeners which is made according to Peter Lynch philosophy and play around. You could simply Google them. But if you are investing and you have like decent portfolio, this could be this approach might broaden your horizons, and between regular ETF investing and regular dividend investing, you could go to some Peter Lynch approach and see whether these stocks are giving you some additional income and diversify you from general indices. And there is nothing wrong there, because if you stack it right, in the worst case you couldn't do worse, because I would bet that you will make at least as much as the general indexes with this simple approach. Whether you will make more, well, then you have to devote yourself rather significantly to these screening and testing processes. But anyways, this is how it works, and if you are a stock investor, you have to understand Peter Lynch approach, because this is like one of the most known investing approaches out there, and at least understanding here is required. So stay tuned, more videos of investing as well is coming, so make sure you are following me, and bye.